Paying taxes. I mean, don't you just love giving the government most of your hard-earned money? What's up? Welcome back to the channel. I'm Johan Lorenzo, and in today's video, we're gonna go over what you can do to save thousands of dollars in taxes and how to avoid some simple mistakes that can cost you big money. We're gonna be talking about the taxes on your regular individual account. This is not your 401k, this is not your Roth IRA, which are tax advantage accounts. We're strictly talking about taxes on a regular individual brokerage account. So there's a few different terms we're gonna cover here today. But the main two you're gonna hear often when talking about taxes and the stock market are short-term capital gains and long-term capital gains. Let's go over them. Short-term capital gains. This is when the government basically robs you blind, for a lack of better words. So this is when you own a stock for less than 1 year and sell it for a profit. Here's a quick example. Let's say you buy 100 shares of Apple for $100 each, a total investment of $10,000. Then 11 months later, the shares are now worth $125 each, and you decide you're gonna sell them and take your profits. So you sell all 100 shares, and now your original $10,000 investment has grown to $12,500. That is a profit of $2,500 on your investment. You've done a great job, but the negative part about this is, since you did not hold the shares for longer than a year, you will now have to pay a short-term capital gains tax, which can fall under any of these 7 brackets depending on how much money you make yearly. So if you have a good paying job and you're in the 24% income tax bracket, you will have to pay 24% tax on that $2,500 profit, which would come out to $600. But if you would have held it for another month or so, it would have put you over the 1-year mark of owning the shares. And now your gains would fall into a long-term capital gains tax of 15%. Which means you only have to pay back 15% of your $2,500 profit, a total of $375. That extra month would be saving you 9% in taxes, a $225 difference. This might not seem like much right now, but trust me, it is a huge difference. And the bigger the profit is, the more noticeable the savings are. Like a $100,000 profit in that previous scenario. A short-term capital gains tax would have you paying back $24,000. But if you held it for over a year, you would qualify for a long-term capital gains tax and instead pay back only $15,000. That is a $9,000 difference. So this brings us over to long-term capital gains. We pretty much touched this up already, but let's give you the full breakdown. This is when you own a stock for more than 1 year and sell it for a profit. There are only 3 tax brackets here, and the highest one you can be taxed at is 20%. So even if you made $1 million profit on your investment, as long as you held it for more than 1 year, you will only pay a 20% tax on that profit. Compare that to a $1 million salary, which gets taxed at the highest income tax rate of 37%. That is a 17% difference, which adds up to $170,000. Now picture that scenario over the span of 10 years. You're talking about a $1.7 million discount over that time frame. It pays to know this, literally. So let's roll right into realized and unrealized gains or losses. To have a realized gain or loss, you simply have to sell your shares. That's the simplest way to remember this. Realized equals selling your shares. Unrealized equals unsold shares. That's the easiest way you're gonna remember this if you're new to this game. Realized equals selling shares and unrealized equals unsold shares. That's it. Remember that. Everything you see in green here on the right hand side of the screen for a profit is an unrealized profit. Yeah, it says I'm up a few $100, but I still haven't sold that position to realize that profit. That money fluctuates daily with the share price changing every day because I'm still holding the shares. If tomorrow the stock market crashes, I wouldn't be profiting anymore. These positions would probably show up in red at a loss. Therefore, everything you see in green here is unrealized, okay? Which means what again? Unsold, right? Because unrealized equals unsold shares, right? You're getting it. I see you little by little, okay? Like my Cuban uncle says, take it easy, man. You got it. You got this, all right? Let's look at another example here. So if you invested $10,000 in Apple, like the scenario we mentioned before, and you cash out a few months later for a profit, that is considered a realized gain. You sold out of your position, and whatever the stock price does from then on does not affect you. You already locked in your profits by selling all of your shares. On the other hand, if your shares went from $100 each to $90, you now have an unrealized loss of $10 per share. So if you decide to cut your losses and sell your shares for less than what you bought them at, that would now be considered a realized loss, since you actually went ahead and sold the shares for less than what you paid. If you don't sell your shares and you are currently down in your position, that is considered an unrealized loss, which basically means you haven't sold your shares for a loss and you still have a chance for your share price to recover and make you a profit in the future. You are still in the game and you're holding a position. Same thing goes if you are up on your shares but haven't sold. If you're up $2,500 on your Apple position but have not sold your shares, you don't have to pay taxes on that gain because you haven't cashed out yet. Therefore, it is an unrealized gain, and that is not subject to tax. But if you do sell your shares and take your profits, that is considered a capital gain and you will have to pay taxes on that. Again, how much tax you pay depends on how long you held the shares before taking profits. So after speaking on capital gains, we must mention capital losses. Obviously, this is the opposite of a capital gain. If you're losing money on an investment and you're not liking where it's going and you prefer to cut your losses, you can sell it for a loss and then use that loss to offset your capital gains. So here's a quick example. Let's say you made a profit on selling your Apple and Home Depot shares, and your profit is $10,000 combined. Then you took a huge loss on some risky investment you thought was going to the moon. And after selling the shares for less than what you bought them, you are down $7,500. Instead of paying taxes on that $10,000 profit you made from selling Apple and Home Depot, you are now subtracting that $7,500 capital loss from your $10,000 capital gain, and you will have your true net profit of $2,500. This total net profit of $2,500 is what you'll end up paying taxes on. So instead of paying tax on that $10,000 gain, you're now only paying taxes on a $2,500 gain because you deducted a $7,500 loss from here. Let's move on to the taxes on the dividends you receive. The taxes on the dividends you receive fall into two tiers. It's either a qualified dividend tax or an unqualified dividend tax. And once again, the long-term holder here is the person who has the advantage. So some people have asked me, oh, but if I don't take my dividends out of my account and I just reinvest them, I don't have to pay taxes on them, right? Wrong. Anytime you get paid dividends, you will pay taxes on those dividends, regardless if you withdraw them out of your account or leave them in your buying power to reinvest them on a later date. The tax advantage part about dividends comes when you own the shares for more than 60 days prior to receiving those dividends. Those dividends will be considered qualified dividends, and you won't have to pay anything higher than a 20% tax on that income. By the way, most people I know usually end up paying about 15% tax on their qualified dividends. That's the income tax bracket they fall in. If you don't own the shares for longer than 60 days, any dividends you collect will be considered unqualified dividends, and they will be taxed at your regular income tax rate. So if you're in a 24% income tax rate, you will pay a 24% tax rate on those unqualified dividends you receive. So in the simplest, shortest version, you do not have to worry about paying taxes unless you sell your investments for a profit or receive dividends. And that is when that little slimeball, greasy little rat Uncle Sam wants to come take a cut from your profits. Once again, this is for an individual brokerage account. A tax advantage account like a Roth IRA works a little different and has different guidelines. So that's a whole nother video for a different day in the future. Also, depending on where you live in the United States, some places have state and city tax. So you might be paying back a bit more in those states compared to states like Florida where we have no state tax. But the most important thing to remember here is, guys, it literally pays to be a long-term investor. You get these huge tax breaks and you also have a better chance of making profit because you're not trying to time the market. In short term, stocks go up and down all the time. You have to understand this. But in the long term, more often than not, stocks usually grow and appreciate in price over the years. There's a famous saying in the investment community that goes like this: time in the market beats timing the market. And this is because it is much harder to time the market. The buy and hold strategy has proven itself over and over to be the leader here. The longer you're in the market, the better your chances are to make a great profit and keep most of that profit as well. Hopefully this video helped you get a better understanding on how you will be taxed in the stock market. Paying taxes is not something we look forward to, but you definitely need to know these things mentioned here today, so when the time comes, you're able to keep more of your money in your pocket. With all that said, I want to thank you all so much for watching. I really do appreciate each and every single one of you. Until next time, peace!